Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I'll be your moderator for today's webinar, Introduction to Canadian Taxation for U.S. CPAs. Our presenter today is Afan Khalid. Before we get started, I wanted to go through some housekeeping items and do some technical checks to make sure everything is working. First, if you don't mind going to that Q&A tab on your control panel, and please let me know if you can hear my voice and see the title slide. Please feel free to let me know what city you're listening in from and one thing you'd like to take away from today's webinar. If anyone has any technical issues during the webinar, please let me know and I'll do my best to get to you in that Q&A tab. I'll do my best to answer your questions as soon as possible. This is also where you can put your questions and comments for the presenter. And we've got, I see NYC, Boise, Idaho, Pennsylvania. They're coming in fast and furious. Thank you so much. So now that we know everything is working, let's go through some housekeeping. This webinar qualifies for 1.5 CPE credits, 1.5. CPE credit will be available within 24 hours in your CPA Academy account. So this webinar is set up a little bit differently than previous webinars on CPA Academy. Instead of polling questions, there will be attendance checks. There won't be any formal polls during this session. The attendance checks will be randomly launched during the webinar. You'll see an image of a hand on a computer mouse on your screen. And when you click that image, it'll count towards your credit requirement. Click it when you see it. You can click it anywhere on that image. To earn your credit, you'll need to stay logged in for 75 minutes and respond to a minimum of 5 attendance checks. And there will be more than 6 generated, so you should have plenty of chances. I also wanted to let everyone know we are recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy account within 24 hours. And if you have to log out and log back in for any reason, the webinar software will keep track of your time. We also recommend you download today's presentation materials, which can be found in the Control Panel's Handouts tab. So now that we're all set, let's welcome our presenter. Afan, the floor is all yours.
Hello, welcome everyone. Thank you very much for joining the session, the webinar today. It's Introduction to Canadian Taxation for US CPAs. I hope everybody is doing great. I am in Toronto, by the way, so in a different time zone than most of you. Okay, so let's get started. My information is over here. I'm going to skip the first slide here. It's just my profile, and if you have any comments, question, feel free to reach out. This is just for you. I've been in public practice for over 15 years, worked with big firms, PwC and other national firms in international tax, mostly cross-border, dealing with US companies coming into Canada, doing business in Canada. I have a lot of expertise in the tax treaties, permanent establishment, residency, and so on. So I've done compliance consulting both in the cross-border context for non-residents, Canadian companies, multinationals, US individuals, and corporations. So any questions, feel free to reach out to me. I have a lot of experience and happy to help you. So let's get started. The objectives, well, upon completion of this webinar, you should be able to have a general understanding of the fundamentals of Canadian tax system, the key terminologies. I have tried where possible to give a similarity in comparison between the US tax and the Canadian taxation, although I will accept that I'm not a US tax expert, so I'll let you guys figure that out. It's the Canadian equivalency or equivalent terminology that we use, or what you will hear from Canadians in general, or if your clients are moving to US, they'll be using terms like T4 and things like that. So, I've tried to do that. So you will learn the basics about the Canadian taxation system. We'll talk about residency. Residency is very important because that determines the tax implication. If you have a US person moving to Canada, Canadian person moving to US, a lot of taxation is based on residency, especially from a Canadian context. Okay, I know in the U.S. it's more citizenship based, but in Canada it's residency. And that's why we'll talk more, a bit about residency for both individuals as well as for corporations. Okay, we'll talk about the tiebreaker rules in the treaty as well briefly. But I'll keep it as simple as possible. I know we have a lot of participants, and by no means I will try to throw a lot of Canadian tax jargons and just to impress you. We'll try to keep it as simple and practical for everybody over here. Upon completion, we'll have a basic understanding of the individual tax and the corporate tax. Some tax rates and the tax brackets, different types of income, especially capital gain, which is slightly just taxed differently here in Canada and so on. And then at the end, we'll try to cover some of the cross-border aspects. If you have clients coming into Canada, what are the tax consequences? In terms of the agenda, I'll try to cover all the points over here, but I will leave about 15 to 20 minutes at the end for Q&A. And Gabriel will be helping me with that. So I'll give you an overview of the Canadian tax system, residency rules. We'll talk about taxation of individuals, corporations, cross-border tax issues, and then finally, when you have U.S. companies doing business in Canada, what happens, especially if you have clients, either individuals or corporations, U.S. When they are, if they have any type of sales or employee presence in Canada, that triggers some Canadian tax obligations. A lot of time it is treaty exempt, but you still have to do some tax filings to claim the exemption under the treaty. Okay. So, the first of all, from a Canadian tax perspective, some general overview. Like you have IRS in Canada, we have a tax agency called CRA, Canada Revenue Agency, which is more of a federal body to oversee, making sure the companies are individuals and taxpayers are in compliant with the Income Tax Act in Canada. And then we have a few provincial bodies. Not all of the provinces have their independent tax agencies. Revenue Quebec is one of the key, or one of the main a tax agency at the province level. And then we have one in Alberta. So in the province of Alberta, they manage their own taxes. Most of the other provinces are kind of harmonized with the federal. So CRA will manage all the filings, means you file one tax return with the Canada Revenue Agency, and then the softwares will automatically work in the back end in terms of allocation between the federal and the provincial taxes. But it's just one thing that you have to worry about, which is very interesting. Unless you have clients with establishment in Alberta or Quebec, you will have to file separate income tax returns. Otherwise, it's just one side of return, which makes things very, very easy. In terms of tax base, same, US, Canada, if you are considered to be a resident citizen in the US, you're taxed on the worldwide income. Whereas if you are a non-resident of Canada, you are only taxed on the Canadian source income. Okay, so that's a similarity. System type, self-assessment, progressive rates applies. The individuals have to self-assess, file their own tax return, report the income expenses, and then the personal tax rates are progressive. They're generally on a higher end compared to the US and the tax brackets, which I will walk you through when we get to those slides. In terms of the key legislation, you have Internal Revenue Code. We have Income Tax Act for income tax, and then for sales tax we have Excise Tax Act. So if you have clients or someone talking about Income Tax Act, that's something equivalent to IRC in the US. In terms of filing deadlines, and this is very important, by the way, I get a lot of US clients who will say, hey Afan, can we file for an extension? Well, guess what, in Canada we don't have extensions. I wish we had extensions, but no. So for individuals, the deadline is April 30th of the following year. So and the year is fiscal, it's a calendar year. So January to December, whatever income you have for individuals, they have to report that income by April or file the tax returns by April 30th of the following year. So, say for 2024, the deadline to file personal tax returns is uh, is April 30th, 2025. We have some nuances. If you're self-employed, the filing is slightly extended until June 15th. Um, and for corporations, it is 6 months after the year end. So whatever is the year end for the company, the corporation can choose its fiscal year end, when they file their first tax return, not at the time of incorporation, but after incorporation. When you file the first tax return, you can choose whatever year end you want as a corporation. And then the tax filings are due 6 months after the year end. However, make a note that, again, I don't know how that works in the US, but from a Canadian perspective, any taxes owing for individuals must be paid by April 30th for the last year, and for corporations, in most cases, it's 2 months after the year end. Okay, if it's a non-resident company, or a subsidiary of a U.S. parent company, then the the taxes owing must be remitted. In most cases, they will be required to pay installments if it's a profitable company, but otherwise, if they're not making installments, they have to pay their tax liability within 2 months after the year end. However, the tax filing is not due until 6 months after the year end. And if you are late in making the payments, the CRA can assess interest and penalties for that. Okay, so that's the filing deadlines. We have April 30th and 6 months after the year end um, for corporations. No extensions whatsoever, neither for individuals nor for corporations. So the deadline is the deadline. And if you are late in filing the tax returns, of course, there is interest and penalties. The penalty ballpark starts at 10%. So, for different type of filings, the penalty can be, the rate might be different, but as a ballpark rate, you just keep 10% of the tax owing is your penalty if you're late in filing your tax returns. For corporate tax rate, in Canada, the federal rate is 15%. The provincial rates can vary depending on which province you have your permanent establishment or nexus, let's call it. That's another term which, I will be using the term permanent establishment, but it's almost as if I'm talking about nexus from a US perspective. So if you have nexus in Ontario, the tax rate will be 26%. If you have nexus or permanent establishment in BC, Alberta, the rate might vary slightly based on the provincial rate. But as a ballpark, if you want to take away, one number from this webinar, then just keep 25%, and the rate will be just plus minus 1 or 2 depending on the province you are operating in. For sales tax, we have GST. So GST applies across the country, and then some provinces have their provincial sales tax rate, and that can vary from province to province. I have included a slide at the end which has the combined rate by province, and it's always based on where the customer is located, or the place of delivery or place of supply is what we refer to. So say if you're selling goods into Alberta, um, then the only GST applies. So 5% tax is what you have to collect. And if you are selling anything into Ontario, then there's 13%. So 5 plus another 8. So it's 13% is the sales tax rate in Ontario. Now, whether you have to collect or not collect, that's another discussion. I don't think I will be focusing too much on sales tax in this webinar, but feel free to reach out to me. For non-Canadian entities or US entities, there are a number of rules, if, when, how, or why they have to collect or register. But then there's an analysis, and I'm happy to complete that analysis to determine if you or your client may be subject to GST, HST filing collection obligation, or if they are exempt. And then finally, from a Canadian perspective, the taxes are based on residency, not citizenship, which, unlike the US. And residency in Canada is determined based on your primary residential ties and where you are physically located. So if I have a home, or I have my spouse, family, kids, dependents living in Canada as an individual, then I will be considered a resident of Canada. But I can have a Canadian passport and say if I'm living, abroad, then for tax perspective, if I choose, I can sever my ties, and for tax purposes, I can say I'm not a resident of Canada, which means that I will not be subject to tax on my worldwide income in Canada. Okay, some key terminologies. Again, this is more for you, but T1 is the term we use for personal tax return, just similar to 1040. T2, a lot of Canadians will use this term T2, which is a corporate tax return for us, similar to Form 1120. For partnership returns, we use T5013 is the terminology. T4s is very common, which is similar to W2. So if a US company is sending employees to Canada, the US company has obligation to comply with the Canadian payroll, remittances and payroll deduction rules, unless they apply for a waiver. And the waiver is very easy process. It's much better to apply for the waiver so you get the exemption, but some filing and waivers have to be submitted. But in an absence of any waiver submitted, yes, a T4 has to be filed, and the US corporation will have to deduct payroll taxes for their US employees working in Canada. Okay. And the same rules apply on the flip side. If Canadian employees are working in the US, I would assume US have the similar rules for Canadian businesses to deduct payroll withholdings. And then RSP, this is equivalent to 401k in Canada. TFSA, it's tax-free savings account, similar to Roth IRA. And GST, HST, which I know, fine, that's sales tax. Notice of assessment, this is the term, or we always also call it NOA, in short, notice of assessment, that is provided to taxpayers when they file either their income tax returns or corporate tax returns, GST, HST, any tax return that has tax associated or tax either obligation or liability. Once you file those returns, the CRA will issue a notice of assessment. And then finally, permanent establishment. This term, we use it more frequently over here instead of the term nexus. But I will, try to use nexus just because it's more familiar to you instead of using the term permanent establishment. Okay. So starting with the tax residency rules for individuals, you are considered a resident of Canada if you have significant residential ties. And what's included in significant residential ties means you should have a home that is available to you or at your disposal, available to you throughout the year. Whether you're living or not, that is another discussion, but having a home at your disposal is a big factor. If you have your spouse living in Canada, again, that's considered as a primary ties with Canada, and having dependent kids is another tie. So if you have house, spouse, and kids, then you're definitely you're a Canadian resident, and if you're considered to be a resident, then you are subject to tax on your worldwide income in Canada. Now, of course, um, you can claim foreign tax credit to the extent you have paid taxes in other countries where you're working, but to avoid double taxation. But Canada will have the right to tax your worldwide income if you are a resident of Canada. And then we have this term called deemed resident. So this applies if you are a non-resident, say a US individual working in Canada, and if they happen to stay in Canada for more than 183 days, in Canada, then they will be deemed to be a resident. But for simplicity, things do get a little complicated, but for simplicity, under the treaty, because of the treaty, U.S. and Canada tax treaty, uh, if you are considered to be a deemed resident, then your Canadian source income is subject to tax in Canada. Okay, so say if you have a U.S. If the U.S. company sends their employees to Canada and they happen to um, stay for more than 183 days. Now, few things will happen. First of all, any waivers that the US company has applied for, payroll waivers, will become invalid, right? Because you have exceeded the 183-day mark. The waivers are only valid if you are staying or your employees are staying in Canada for less than 183 days. Otherwise, under the treaty, the employee become taxable. And then the employer will must issue a T4 slip, which is similar to W2, and the employee must file their Canadian tax return, get a temporary SIN or tax identification number, which we call ITN, and has to pay tax in Canada first, and then in the US, when the individual file their regular tax return 1140, they should be able to claim a foreign tax credit for any Canadian taxes paid. But if you are staying in Canada for less than 183 days, and there are a few other conditions, then you should be exempt. Or if you have already applied for the waiver, then your salaries are exempt from Canadian taxation. Okay. And as a non-resident, as a non-resident, um, and without treaty, okay, if you're a non-resident, then you are subject to tax on your Canadian source income. It also depends on the type of income, which I will explain, whether it's dividend or interest income, employment income, capital gain income. I will provide more details as we go through the presentation. Um, and you answer, but generally for non-residents, they're only subject to tax on the Canadian source income, subject to tax treaty. Tax treaty can override um, can override the Canadian domestic tax law, and whether the income is taxable or non-taxable. But in absence of the tax treaty, as a non-resident, then you're only taxed on your Canadian source income. And then there's a term called part-time or part-year resident. This generally applies when you permanently leave Canada, or you're a first-time immigrant. You enter into the country and establish your ties with Canada. So say if a person, became an immigrant or moved to Canada, say November 1st, then, and, and then say 2024, November 1st, 2024. So they will be subject to their worldwide income for the 2 months from November to December 2024. Any income they earned, in the previous month before becoming a Canadian, permanent resident, that will be exempt from Canadian tax. So when you leave Canada or enter Canada, you are only taxed on your worldwide income in Canada, while you are a resident. Okay. Uh, few some additional details on the residency. Um, if as an individual, there are two layers of test. One is the primary ties, and second is the secondary ties. If Of course, a combination of both, but primary ties matters most. So the primary ties are the significant residential ties to Canada. That's you're having a home or available to you at your disposal. You have common law spouse and Canada, dependents in Canada, and and then secondary ties become relevant after the primary ties. This is having car, furniture, or social ties, memberships in Canadian gyms and so on. Economic types, working in Canada, having a bank account, credit card, driving license has a lot of importance. Having a Canadian passport, or even having health insurance, like CRA here has some their own administrative policies. If you are using Canadian health system, and you have your Canadian health insurance or health card, then they will just automatically call you a Canadian resident. But again, it's a question of fact, and if you have clients who are running into these issues, happy to help. Okay, for corporations, it's quite simplified, especially under the tax treaty. But the comments over here, I will answer without the treaty, but I will explain if the treaty applies, what happens. So if it's a resident corporation, it will be taxed on worldwide income. What is a resident corporation? A resident corporation is a corporation that is either incorporated in Canada or has mine management in Canada. Um, and this can include having board of directors in Canada, not just in Canada board of directors, but if they are actively meeting and exercising their authorities of the board of director in Canada, means all the meetings are held in Canada. Then that company is deemed to be a Canadian corporation. But generally, if it is incorporated in Canada, it is considered to be a resident corporation and taxed on worldwide income. For non-resident corporation, in absence of the treaty, um, they are generally subject to tax on Canadian source income. And in the context of the tax treaty between US Canada, we get into the permanent establishment rules and residency rules and so on. But again, it's the for non-resident corporation, it is taxed on the Canadian source income only. Unless you have your mine and management problems, or mine management board of directors are in Canada, then there can be other issues. However, the good thing between US Canada tax treaty is that there's a tiebreaker rule for corporation, which says that if a company is incorporated in US, it is a resident of US. And if a company is incorporated in Canada, it is a resident of Canada. Now we can argue on having a permanent establishment or having a branch. If you have mind and management in another country, it can create what you can call it as a branch and subject to some different type of taxation, permanent establishment or business profits being subject to tax. But residency, there's a clear cut rule in the tax treaty, so we don't have those problems. But say if I have a client who say is a Canadian permanent resident and who owns a corporation in Hong Kong, but he's the owner, shareholder, director of that company. The company is in Hong Kong. Then guess what, that will be deemed to be a Canadian corporation. By why? Because the mine and management is in Canada. Okay, so we have to look at the tax treaty all the times for that. And then deemed resident corporation, again, outside the scope of this webinar, but I just want to clarify, certain corporations, trust, partnerships, and other entities can be deemed to be a resident of Canada under the tax treaty, or in absence of the tax treaty, in which case may be taxed on worldwide income. Sort of a complex area, but if you have something, happy to help. Okay, so this slide explains the different types of income or different income streams and the tax treatment. Okay, and now this might be very different compared to US. And I'm not, as I said, I'm not a US tax expert, but you can sort of compare on your side how Canada looks at different streams of income, and how is it taxed in a different manner. So if you're earning employment income, then you will be issued a T4 slip for that income. So that can include your wages, salaries, and bonuses, reported on T4 by the Canadian employer, or if it's a US employer that are sending their US employees working in Canada for 3 months, 5 months, 10 months, 1 year, 2 year secondment, whatever, then the US employer has to issue a T4 for that. The employment income is fully taxable at the progressive rate. I'll share the rates in one of my slides, how the tax brackets are laid out, and how the tax rates will increase as you get into a higher income bracket. Okay, so that's our employment income. um, for employment income, in some limited cases, you are allowed to deduct certain expenses, but there are a lot of restrictions on what expenses you can deduct. There is a there is a difference between an employee versus a commissioned employee, like a salaried employee and a commissioned employee. The commissioned employee is allowed to deduct a little bit more expenses, whereas if you are straight you're just a salaried employee, then you have a lot of limitations. But I just want to point out that you're allowed to deduct certain expenses from your employment income. And then we have the category which is self-employed individuals. So they're just running a business as unincorporated individuals who are, who can register and do business as an individual uh, business. And a lot of accountants, they don't want to incorporate a professional corporation or anything. Can operate as a self-employed or unincorporated businesses. They are allowed to deduct all the expenses, all the business expenses that are directly related to the business. They should be allowed to deduct that. But any income, that is their net profit, will be fully taxable at the progressive rates. Okay, but you're allowed to deduct business expenses. Income is different. So this can include your bank interest, and interest on bonds or mortgage interest and so on. The issuer is supposed to issue a T5 slip. Again, I don't know what slip will be equivalent in the US, but a T5 or T3 slip is issued when the payer corporation or financial institution is paying interest to the Canadian taxpayers. Okay, that income is also fully taxable, and as ordinary income and taxed at the progressive tax rates. That's fine. However, you are allowed to deduct any expenses incurred to earn interest income, or that for that matter, like any investment income. If you earn investment income, you happen to pay fees to investment advisor or any interest on loan borrowed to make the investment or to make the purchase of the investment, you're allowed to deduct those expenses. Dividends, this is tricky. With dividends, we have a bifurcation of whether it's a dividend from a Canadian company or dividend is from a non-Canadian company. A dividend from a non-Canadian corporation is treated like as any ordinary dividend or any ordinary income, will be taxed, fully taxed at the progressive rate. And say, if I am a Canadian, resident person, and I have invested in US stock market, and I'm earning some dividends on US stocks, and of course there will be some withholdings on the US side. On the Canadian side, on my tax return, I will report the US dividends as foreign income. There again, as I said, ordinary income, considered ordinary income, but I will be allowed to claim a foreign tax credit for any withholding taxes that I've paid on the foreign dividends. So that's one of the categories for dividend, like foreign dividend. Now with Canadian dividends, we have two different categories. There is large corporations or public companies. So any public companies or large corporations, when they pay out dividends to general public or investors, the Canadians get a preferential tax treatment. So as an investor, if I invest in TD Bank or RBC, which is one of the largest banks here in Canada, if I invest in those stocks and receive a dividend, I will get a preferential tax treatment for that income compared to me earning employment income, let's say. Okay, so there's a preferential tax treatment for dividends I've earned from large corporation. And if I'm earning dividends from small private companies, or I'm a small business owner and I pay myself dividend out of my corporation, those dividends are relatively taxed preferentially compared to your salary income, but not as preferentially taxed as earning dividends from a large corporation. The reason why there's a difference is because small businesses are taxed at 11-12% in Canada. The small business get a preferential tax rate. So they're only paying tax at 11%, 12%. So when those companies will pay out dividend to the business owners, you know they don't get enough credit compared to large businesses, and large businesses are subject to tax at 26, 27%, even as high as 28% in some provinces. And so when a company that is paying high tax rate is paying dividends to its investors, then those investors will get a much higher dividend tax credit, let's say. Okay, so that's the dividend income. Capital gains, again, very important. I think I have a separate slide on capital gains, and I will explain more. But unlike in the US, where capital gains are 100% included into income, um, from a Canadian tax perspective, capital gains are 50% included into income. So, say if my total gain on disposition of a property is $150,000, then only 50% of the gain will be included in my income. The other 50 is tax free, other 50%. So, on a $150,000 of gain, I will be paying tax on only 75,000 of the gain, and that 75,000 is ordinary taxed at the progressive tax rates, no problem. But it's just the key difference is the inclusion rate. Okay, capital gains are included at 50%. Now, there was a currently there is a talk, and the conservative have proposed that the inclusion rate be increased from 50% to one third to two third, basically, from as an inclusion. But again, it has not become a law. Okay, so for now, as a takeaway from this presentation, 50% is the inclusion rate for capital gains. And there are a few other nuances for capital gains and capital losses, and I will explain that when we go to the other slide. Okay. Rental income is another category. And with respect to rental income, of course, you're allowed to deduct mortgage interest. However, the principal loan payment is not deductible in Canada. You cannot deduct the principal you're paying towards the property. But your interest towards the rental property, and again, there's a difference between a rental property and a principal residence. I will explain that more in another slide. But if it's a rental property, then all the rent collected is taxable. I will report that as my rental income. I'm allowed to deduct all the rental expenses, including the depreciation at the prescribed rate on the rental property is allowed. I can take that depreciation. There are a few rules to restrict the amount of depreciation I can claim. Basically, I cannot create a loss as a result of tax depreciation on rental property and so on. So some restrictions apply on the deductibility of expenses, especially with respect to the tax depreciation. But otherwise, if you have a loss just because you happen to pay too much interest on your mortgage, then yes, you're allowed to claim a rental loss, and that can be applied against all sorts of income. Okay. However, if it is a principal residence, then gains on principal residence are fully exempt in Canada. Okay, I don't know how if that's the same in the US. Happy to know, but in Canada, the gains on your principal residence, the house that you live in for personal use, and you can only designate one house, you know, for a given year as your principal residence. If I have multiple properties, then only one house. There are a few other criteria, but only one house can be your principal residence for that year, and the gains will be exempt. Okay, and then finally, for the foreign income, similar to foreign dividend, like foreign income, foreign interest is taxed as regular income. However, you're allowed foreign tax credit against the Canadian taxes owing on that income. Okay. Okay, so moving on, I think we've covered all the types in for the explanation. Okay, so this is the slide for progressive tax rates for individuals in Ontario. These rates are for 2024. And I'm only showing for Ontario because that's the province where most of the activity is. It's a financial hub. But definitely, if you want references or the tax rates for other provinces, reach out to me. I'm more than happy to share the rates. And what I've done is just to make it easy for you, I've rounded the brackets. Like these brackets are now not rounded, but I have just rounded to the nearest thousand. So it's easy for you to identify, okay, what bracket we're talking about and what rate will apply. You will see that in the previous slide I was talking about different type of income. So first of all, capital gains, because of the 50% inclusion rate, the income is only 50% taxable. You can see capital gain tax rates are almost half of the other income. If I am in the $100,000 bracket, say, and I'm subject to 31% tax, then if I'm earning capital gain income in that tax bracket, then I will be paying 50% tax. 50%, 50% tax. Okay, so you can see capital gains is just half of my other income. For dividends, if you remember, I explained there's public company and large private company dividends. Because these companies are paying a higher tax rate or general rate at 26, 27, 28%, uh, these dividends are subject to a higher dividend tax credit and hence more preferentially taxed. You can see that the highest tax rate an individual can pay on eligible dividends is about 40%. Okay, in Ontario, by the way. Whereas if you are earning dividend from small private corporations, because these companies are only paying 11, 12% corporate tax rate, these dividends are subject to tax at a higher rate, means you don't get a higher dividend tax credit. Now, as far as I know and have discussions with my colleagues in the US, these brackets are too small, and the tax rate, increase at a much faster rate compared to the US. But that's Canada. So you can see, ballpark, if you are in a 100 200 and $12,000 bracket, you're subject to somewhere about 37% tax. Again, this is federal plus Ontario. If you are in different province, the rate might be slightly different. And in the highest tax bracket, if you are making more than 247, you're subject to somewhere around 53% tax rate, and so on. Okay. And then ineligible dividends. This means all other income that we're talking about: rental income, self-employed business income, foreign income, any other category of income will fall into this, the second column over here, for tax rates. Okay. The only exclusion is for these three other types of income, which is your capital gains, eligible dividend, that's large corporation dividend, Canadian corporation, and a small private corporation. Well, one of the interesting things that you will note over here is that up to, say, $50,000 of income from a large private corporation is almost tax free in Canada. And it's the same thing for small businesses as well, like up to $36,000. The dividend from a small corporation is not subject to any, like, it's like basically 0% tax you will be paying personally when you receive dividend from your corporation, but it has to be under $36,000. Okay. Okay, talking about capital gains and losses, what I've tried to do is I've tried to compare the tax treatment of capital gains and losses between US and Canada. I apologize in advance if my interpretation of the US rules is slightly incorrect, but for the Canadian rules, that's 100% accurate. Okay. So in terms of the inclusion rate in the US, as I understand, 100% of the gain is included, whereas in Canada it's 50% as of now, unless some rules changes in later on. But for 2025, guaranteed it's 50%. Okay. And then in the US, there's a concept of long-term and short-term um, categorization for capital gains, whereas in Canada there is no such distinction whether it's long term or short term gains. All the capital gains have an inclusion rate of 50%, and then once the income is included in your income, that portion of income will be taxed at the progressive tax rate, whatever tax bracket you are in. Okay. Now we have a concept of business income versus capital income. Means if I have just one rental property, or if I sell one rental property, yes, it is capital in nature, and I can get a capital gain treatment, and only 50% will be include my income. But if I am, you know selling multiple real estate properties in any given year in multiple years, then then that is considered to be a business, and then all of the income will be subject to tax. Okay, so we have that distinction between capital and business. For capital gain, there's a series of criterias for you to fall into the capital gain category. Okay. And then capital loss treatment is also different in Canada. Uh, Capital losses are very, very restrictive, means they can only be used to offset your capital gains. You are allowed to carry back the capital losses 3 years, and you can carry forward indefinitely, which is, I think it's same as the US rules, so no differences there. But they are very limited in its application. The losses can only these capital losses can only be applied against capital gains. Okay. And then I was explaining the principal residence exemption. So this is the house that you own, and you live in that house. If it meets certain criteria, you can designate your house as a principal residence. You can only designate one house in a given year as principal residence. If say if I own a cottage or rental property and my house that I live in, then I can only choose one of that property as a principal residence in any given year. Okay, but 100% of the gain on my principal residence is exempt from Canadian tax net. Okay, and that's a very, very good thing. Okay, I think we have covered everything on this slide. Short-term, long-term gain, we have no distinction. All the gains have a 50% inclusion rate, and then whatever portion is included is subject to uh, the the progressive tax rates. Okay, so let's continue. In terms of corporate taxation, so now we are moving from individuals to corporate income taxation. The federal tax rate is 15% federal plus the provincial tax rate, as I previously summarized in my earlier slide. Um, you can expect the tax rate to be 25, 26%, or 25%, as if that's the number you want to take away. Probably easier to remember, but between 25, 26 is the rate, combined rate, federal plus provincial, depending on which province you are operating or have your nexus in. So that's the federal tax rate. The provincial rates vary across the provinces. And small business, there's a deduction available to small businesses, which is why they are subject to only 12% tax rate. Can be 10%, 11%, but it's half or more than half than what the general rate is, and that's about $500,000. So any private company, uh, their income up to first $500,000 is taxed at 11, 12%. And then any income in excess of this $500,000 limit will be taxed at the general rate, which is about 25, 26%. We have this, the tax system is designed to basically, we call it a tax integration system to avoid double taxation, because you have income that is being taxed at the corporate level, and then the income flow to in the hands of the individual or the shareholders paying personal tax on that income, whether you call it salary or dividend. So we have, again, it's not a perfect system by any means, and then depending on the province it can get very penalizing. But overall, the tax system is trying to achieve a harmony or integration between, if I'm earning income personally versus using a corporation, paying lower tax, but then when I pay myself dividend salary, I should be in the same overall I should be indifferent, and in the perfect world I should be indifferent if whether earning salary income or income through a corporation. However, that doesn't work. There are differences. And of course, if you have a corporation, the key advantage of earning income through a corporation is deferral. Okay, to the extent you can leave money in the corporation, you don't pay personal tax on that, and it's the deferral is the key advantage more than anything else. And then the filing requirements, in the US you have 1120s. Here in Canada we call it T2 corporate income tax return. Okay. And let's continue. Okay, this slide, based on my experience, I know in the US you have so many types of entities, and then those entities can again file election to be treated as something else, whereas in Canada it's very, very simple. You are a corporation or a partnership or a trust individual, but we don't have a lot of variations. So what I thought it would be a good idea to show some comparison between the entities in the US and in Canada, and how they are viewed from a Canadian tax perspective. Okay, so I'll try to explain that in easy language here. So you have LLC, which is viewed as a flow through by default, flow through entity, and the members you know generally pay tax on the income. It's almost viewed as a partnership if it has more than one member, or a disregarded if it is a single member LLC. But, in Canada we don't have that concept. If it's a corporation, it's a corporation. It has to pay tax on the corporate income, and any payment out of that corporation to the shareholder will be called dividend. Okay, so that LLC is not recognized in Canada. And in the cross-border context, when we are talking about international tax, and looking at the tax treaty, then in that cross-border context, US LLC is treated as a corporation from a Canadian perspective. It does not matter what or how it is taxed in the US. You can be a flow through partnership, whatever, but from a Canadian perspective, we will view it as a corporation, and means, there can be hybrid mismatch and issues in terms of how it is taxed in the US versus how it is taxed in Canada, and can create some complications. Okay. And then, in the US, of course, LLC can elect to be taxed as an S corp, or corporation. And but again, in the US, from a Canadian perspective, a corporation is a corporation and is subject to corporate tax. Any payment out of the corporation will be a dividend. And that's exactly what the C corporation and S corporation is. Even though in the S corporation, I know it is a flow through entity, but well, that's again, extra confusing. But from a Canadian perspective, an S corporation is a corporation for Canadian purposes. So you know, we don't get confused with the flow through factor, but we do get confused with the LLC. Saying it's interesting. But a C corp is like a regular corporation in Canada. So in Canada, if you incorporate a company, it is a regular corporation. We don't have this concept of flow through or filing an election to change its characteristic of how the income will be taxed and so on. If you really want a flow through, then get a partnership for yourself. So in Canada, if you want a flow through treatment, then partnership is the only option. And partnership is uh, it's the terminology we use is T5013 for flow through partnership entities. Okay. And then there's something unique about Canada. Well, at least I have one thing to add here. Is an unlimited liability company. It's ULC. I have very limited knowledge of the US. I think it is very rare in the US, but from a Canadian perspective, a ULC is quite popular for flow through treatment from a US perspective. So when US companies are setting up structures in Canada or acquiring Canadian, subsidiary or so on, they might prefer a ULC because it offers flow through treatment from a US perspective. But from a Canadian perspective, corporation is a corporation, as I said, means nothing. If you incorporate, you can call it ULC, limited liability, LLC. If you incorporate a corporation, it is a corporation, will be paying taxes and so on. But from a cross-border context, yes, because the US rules will view a Canadian ULC as a disregarded entity or partnership, depending on, single member, multiple member, then, it can help in a cross-border context instead of using a regular corporation. Okay. And then finally, we have, sole proprietorship, which is unincorporated um, individual. Okay, there can be many other types, LLLP and LPPPP and so many other types. Happy to, assist if you have questions or anything. Feel free to reach out. I'm more than happy to assist and look and guide you from a Canadian perspective on the Canadian tax implications of U.S. companies coming into Canada. I have a lot of experience for, U.S. partnerships or LP structures and, LLC structures, C corp, S corp, waivers, and so on. So anything, if you're doing business in Canada, that's my area of expertise. Okay, I think this is helpful, so we can move. Okay. This slide, I decided to add this slide just to give you a context of what triggers Canadian tax liability for a US person or a US corporation. Okay. If one thing you want to take away from this slide is, of course, none of you are over here to learn too much about Canada or Canadian tax system, but at a minimum, for those of you who have their US companies doing business with Canada or in Canada, one thing you want to take away is, at what point my US company has any sort of Canadian tax filing obligation. Okay, so that I am in compliant with the rules and, don't get any penalties and so on, or I can get the Canadian contracts, keep getting the work that I'm getting, or continue to sell to the Canadian customers and so on. So, this slide will help you. There are two slides, this in the next slide, but, this is in particular the most important slide that will, guide you as to when a US company has any sort of Canadian tax obligations. Now, keep in mind that this slide is from an income tax perspective. I'm not talking about the customs and border and the tariffs, or I'm not talking about the employees, mobility cross border, or the GST, HST. Everything has different rules. This is strictly income tax. Okay. So for US employee coming into Canada, um, if the person or if a US employee is coming to Canada on short business trips for client meetings or employment duties or consulting, construction, installation, whatever, the moment a US company has their employees, on ground in Canada, they've crossed the border, the Canadian, that's the trigger point. Means now you have to do something. In most cases, I can submit a waiver very quickly, and the problem is solved. No problem once I submit the waiver. But but the trigger is crossing the border. At the moment US employees cross the border, there's some action has to be done. And if you're caught by the CRA, then of course the interest penalties for not complying with the rules. Easiest thing is to get in touch with me and I can submit the waivers, so you're protected, or employees coming into Canada are protected. And then for corporations, so US corporations that are considered to be carrying on business in Canada have tax filing obligation. Now, the treaty will provide the protection on it, whether the profits are taxable or not. But in order to make sure you get the exemption under the treaty, you have to file a tax return in Canada and say, hey, Canada Revenue Agency, we have $2 million of sales in Canada, but guess what? I'm exempt under the tax treaty. Okay. Like if you're not doing anything and saying, oh, I should be exempted under the tax treaty because I don't have permanent establishment, well, CRA can still apply interest, sorry, not interest, they should be able to apply penalties. And our penalties are not as high as US failure to file penalties, but it's still, those penalties are significant. So if US companies are selling any goods and services in Canada through employees or agent, again, the key over here is if your employees or contractors or agents are crossing the border, that's is the tipping point. Otherwise you might be fined. From an income tax perspective, GST HST rules are separate, and happy to guide you if you have those questions. So let's look at another example. If you have employees of a US company that are soliciting, performing sales and marketing activities physically in Canada. So again, if you're doing it remotely using social media platforms, or Google ads and Facebook, Instagram, TikTok, whatever, you should be fine. There's no that should not trigger any income tax obligation. But the moment you are sending your employees to Canada for client meeting, client service, consultation, installation work, construction, or whatever, that's the trigger for both for employee and corporation. And we can submit the waivers. If the waivers are done on timely basis, you should be fine on both sides, for corporate and for income tax. There's some filing and compliance, but you're protected under the treaty, no problem. And then finally, US employees coming into Canada to attend client meetings, trade show, conferences. These are all the examples that will trigger Canadian tax obligation or filing requirement. But then the treaty will provide the protection. However, you have to file the tax return for that treaty protection to be live and applicable. Okay, and again, I'm happy to help you and your clients with that. Okay, finally, if US corporation or an individual dispose of Canadian real property, that is another trigger point for Canadian tax liability. Generally, when a non-resident or US individuals that holds a Canadian interest in a Canadian real estate, if they sell their interest in the Canadian real estate, that you know there's 25% withholdings at the gross value unless you do something about it. And there's filings, and a lot of things that we can do to minimize the tax implications. But if you have clients who are selling Canadian real estate, now this thing, you cannot miss that, because the lawyers on both sides of the transaction, they will make sure and confirm the residency, and this will be done on the taxes will be withheld at source. So if you have a client, let's say, if you have a client who is selling a condo for $1 million, let's say, in downtown Toronto, next to the CN Tower and whatnot, it's worth $1 million, 3-bedroom penthouse. I think that the value might be more than a million, but let's say we're going with the $1 million example. Well, if you do nothing and just tell your lawyer that I'm a US resident, I'm selling this condo for $1 million, the lawyer will withhold 25% of the gross value. You may have paid $900,000 for that. So you cannot afford to pay $250,000 in withholding taxes. So you have to immediately submit the waivers, and certificate of compliance with the CRA in order to reduce your withholdings to on the net profit. You are okay to pay 25% of the net profit, but not 25% at the gross. And I think the rules are quite similar with the US FREPTA rules and so on. There are still similarities and differences between FREPTA and the Canadian TCP, taxable Canadian property rules. But once if action is taken immediately, then the tax consequences can be significantly reduced. Okay, and I happy to help with that. So and these rules don't only just apply to real estate property that is held by an individual, but if you own shares of a Canadian corporation that drives its value based on the underlying real property or resource property, the same rules apply. Say I can own the same $1 million condo in a Canadian corporation, the same rules will apply. The fact that more than 50% of the fair market value of shares of the Canadian private corporation is derived from underlying real property, those shares are tainted and are considered to be, say, taxable Canadian property, and the same withholding tax rules apply 25% unless you can plan accordingly. And then finally, we have withholding tax consequences on U.S. corporations and individuals earning dividend income from Canadian sources, interest, rent, royalty, management fee, and so on. The domestic rate is 25%, which is then reduced under the tax treaty. On dividend, the rate is reduced either 5% or 15%, depending on the percentage of ownership and so on. Interest is generally zero rated. I think I have another slide where I will be talking more about that. So let's just hold on to this. Okay. 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 I think maybe one thing that I will clarify in my previous slide is that for individuals that are earning Canadian source employment income and they are working in Canada for however many number of days, in absence of the waiver, uh, yeah, the U.S. individuals have to file T1 tax return, which is similar to 1140. Corporations, if they are doing business in Canada, and of course, in order to claim the treaty exemption and all whatnot, they have to file a corporate tax return. It's also referred to as treaty-based tax return. And then in respect of selling real estate property, whether it's held by individual or US corporation, same thing, you have to file T1 or corporate T2 return in Canada to calculate the final taxes owing. Okay, the withholdings are preliminary taxes that are withheld, but then the final liability is determined when you file your T1, which is 1120. 1140 or 1120, which is our corporate T2 tax return. So final return has to be filed, okay, which is quite similar to the US rules. However, well, there's the distinction. However, if you're earning dividend income, interest, rent, royalty income, these passive sources, income from passive sources, then you don't have to file any Canadian tax return. The withholding taxes that are applied on these passive income is the final tax on the Canadian side. The issuer might issue you a NR4 or some NR number slip to you, but that's about it. In the US, you can claim foreign tax credit, and that's it. But you don't have to file a tax return. It can be some nuances if it's a rental income, and you're happy to guide you. If you happen to have rental property and you want to pay withholdings on the net, reach out to me. Okay, here is an interesting example. So it's a case study. It's a US company selling goods to Canada with frequent visits to Canada. So the employees are frequently visiting Canada, and that's the trigger point, which is why I have that in the heading. So let's look at the facts. So US company sells goods to various distributors and retailers in Canada. The employees of the US company frequently travel to meet with customers in Canada, and that's the tipping point, by the way. There is no office or permanent establishment or nexus in Canada. There are no Canadian resident employees. However, it's the US employees that are entering, crossing the border, visiting the customers, or doing the work, construction, consulting, professional, whatever the work is. In terms of the Canadian tax implication, yes, the fact that the US employees are crossing the border, that's the trigger point. US company is considered to be carrying on business in Canada. It is required to file a Canadian tax return. And on that tax return, it can claim an exemption under the treaty, which is saying that, hey, I don't have a permanent establishment or nexus in Canada, so I should not be paying any taxes. Fine, you will get full treaty protection. There's no dollar threshold for that, by the way. I have US companies with up to $50 million of revenues in Canada. As long as you can manage your affairs to not create a permanent establishment in Canada or not create a nexus in Canada, your income is exempt under the treaty. Okay, so happy to help you and your clients structure their affairs in a manner to not create permanent establishment, and hence you don't have to pay any taxes in Canada other than filing these exemption returns. You will be required to register for a Canadian tax identification number. So that's BN or business number. There's definitely a requirement to register for GST, HST, sales tax, and collect 13% on Ontario, whichever province you're working. So sales tax implications will apply in this scenario. A payroll waiver, unless I apply for the payroll waiver for your employees coming into Canada, there are payroll tax implications, HST, sales tax implication, and income tax implications. Okay. Most of these things can be managed if I can take action ahead of time. But GST, again, it's not a cost to the business. If you're collecting 13% from your Canadian customer and then passing it on to the CRA, so that's more of a compliance, but it is not a cost to the business, right? Like income tax, we can file treaty-based tax return and waive, the tax if there's no nexus in Canada. Same thing with payroll taxes can be avoided if you submit the waivers. And HST is sales tax. That's just a pass through, so not a final cost to the business. Okay. If a US company is providing services and it's 100% remote, guess what? You have no issues. Okay. Well, guess what? There is a small catch, but let's go through the facts. You have a US company that provides IT solution services to customers in Canada. None of the US employees travel to Canada. That's the main factor. There are no Canadian resident employees. There is no office, no permanent establishment, no nexus in Canada. Good. In terms of Canadian tax implications, the US company is likely not considered to be carrying on business in Canada. No particular tax implications, but you have to watch for the GST HST rules. The GST HST rules were recently amended to account for the e-commerce trade and US vendors selling to Canadian customers. But and it even happened to me. If I have to choose between two vendors, I would choose a US vendor, because they will not be charging HST or sales tax. So I will not choose a Canadian vendor because they are forced to charge GST, HST. So the rules were implemented to make sure it's level playing field. Means if you're selling through e-commerce platform like Amazon, Walmart, Best Buy, and so on, all those non-Canadian retailers or vendors are required to charge GST, HST. Some of those nuances apply, but otherwise, if you're operating 100% remotely, I don't see any tax implications. Okay. Okay, and the only thing I have changed between the previous slide and this current, this slide in terms of providing services is US employees frequently travel to meet with customers in Canada, and that changes everything. Okay, it is one cost. Even if it is a single trip, there's no threshold on the number of trips or what. Like if this is the fact that the US employees are coming into Canada, that's the tipping point, and then all the Canadian tax implications apply. Requirement to file, requirement to register, requirement to collect GST, HST. Of course, I am over exaggerating over here for GST, HST, but just keep in mind that if there is cross border travel involved and work is being done on site in Canada, there are Canadian tax issues to be addressed. That's the key takeaway. This is just a summary slide that I've prepared in terms of the structures you can have. You can have a US company that is just sending their people into Canada, which we call as doing business in Canada without a nexus, without a PE. If you are sending people, yes, there is a requirement to register or obligation to file a tax return. Probably no final tax liability because there's no nexus or PE. But in some instances, there might be some withholding taxes. Again, I can help you waive those withholding taxes. There's no legal liability protection on the Canadian side of the borders if you have employees in Canada. But requirement to US company must register for a tax ID, sales tax, payroll taxes may apply, and there's a requirement to keep your books and records in Canada unless you get a permission from the CRA. US company can also create a branch, which is nexus or PE in Canada, and under the tax treaty, then your profits attributable to the branch are taxable in Canada. You have to file the tax return. Of course, no exemption under the treaty because you have the branch in Canada, and the GST HST rules apply, payroll tax apply, and so on. And then if you have a Canadian subsidiary, then of course it simplifies a lot of things for US parent company. The US company is out of the tax net, but the Canadian subsidiary will have to file the taxes, GST, HST, everything is shifted. All the tax responsibilities are shifted to the Canadian subsidiary, and the US company, unless the US company itself has any cross-border activity, means they are sending US resources to do jobs in Canada, that is separate. Otherwise, if it's only parent subsidiary relationship, then US company has no, tax obligations. The Canadian, everything is shifted to the Canadian subsidiary. Okay, this is a very short summary of with and without the tax treaty. So general rules for that apply to non-resident. Their employment income is taxed in Canada, no thresholds. Business income as a non-resident corporation earning business income taxed in Canada, no exceptions. Capital gains realized by a non-resident, generally taxable in Canada in absence of the treaty. And then any passive income is taxed at 25% withholding tax rate. You can see how the treaty really provides a lot of protection and gives you the benefits. So if the US Canada treaty applies, then any employment income is exempt from tax unless the US person is in Canada for more than 183 days. For business income, if it's a US company, your business income is exempt from tax in Canada unless you have PE or Nexus in Canada. Capital gains are fully exempt under the treaty unless the gains are tied to real property, and withholding taxes are significantly reduced from 25%, which is the domestic rate, to 5 or 15% on dividends, 0% on interest, and royalties is 0 to 10%. Okay, very quick overview on GST, HST. GST is a federal 5% tax rate that applies to anything across the country, but then you have provincial rate, and some provinces are harmonized with the federal CRA, in which case there will be one single rate charged to you based on the provinces. Quebec administers their own uh, retail sales tax, which is referred to as QST. And on the next slide you can see, actually I will leave this slide, you can quickly read, but the next slide over here has the rates. So you have Alberta 5%, British Columbia is 5% GST HST, Manitoba 5%, and then Nova Scotia is 15%, Ontario 13%, and so on. It's not the cost to the US corporation. The residents in Ontario or the across the country are used to these taxes. So as a US company, if you come and charge these taxes, it was just obvious for us that you will be charging and we will pay the tax. So it's not a cost to the US corporation. It's just a matter of you collecting it, staying in compliance, and then remitting the tax to the government. Okay, I think we have about 15-20 minutes for any Q&A. I hope you found the session to be very useful. If you have questions, please reach out to me. I'll be more than happy to assist. And in terms of the questions, I will go to the priority tab. So, and let's see if I can answer the questions. So starting first question is from Brian. I'd like to understand CCA, capital cost allowance, and accounting for difference in financial and tax return. Well, Brian, that's very easy. CRA, if you were to search CRA and then type capital cost allowance, the CRA website has the rules for CCA taxation, and the prescribed rates, say if it's automobile or equipment, then what is the rate. If it's a computer equipment, what's the prescribed rate of tax depreciation, and few things. You can find that. Otherwise, feel free to reach out to me. Happy to help. Glenn is asking if consulting services are provided remotely from the US. Is the US consulting doing business Canada? No, as long as, Glenn, everything is done remotely, you're good. No issues with Canada, except if somebody is crossing the border. So the only fact you have to be very careful if employees or contractors. Again, doesn't have to be just employees, but even if their contractors are coming into Canada to complete the job or anything on site, you have issues. Um, then Leanne has a question. Can you please explain how the dividend tax credit works, especially in relation to how it's reported on T5? What exactly it is it? Leanne, that's a more involved answer. It's not difficult, but it will take me some time to explain. Um, Feel free to reach out, and happy to help if it is something easy. At least I can refer you to CRA website or another website that has some explanation to it. But in the limited time I have, I'm so sorry I cannot answer that question in detail. Max has a question. What if employees of a company based in US plan and execute a conference on site in Canada, but are paid regular US salary? Does employees have to file Canadian tax return? Oh, and that's unfortunate. The answer is, if you have the US executive are coming into Canada, the employer, the company is deemed to be carrying on business Canada, and all the problems is, the payroll exemption needs to be submitted and whatnot. It really depends and comes down to the risk threshold. If it is only one time meeting, fine, who cares. But if that is something you will be doing more frequently, then it's best to just consult. Happy to address this. The US company definitely should register for a business number. And once you have the waivers in place, you can come in and do as many meetings as you want. So it's just a matter of your risk threshold. You can say, who cares? Let's see if the CRA can ever catch me. But once it is more frequent, then I think the risk for detection risk will increase significantly. Vinny has a question. Does Canada has any minimum income tax filing requirement? I have an individual who is dual US Canada resident, 20 years old, studying in Montreal. Last year she earned about 2,500 US. Well, that's true. I think the minimum threshold in Canadian dollars about $15,000. If generally, I would recommend that anyone should be filing a tax return, because there are a number of credits and GS2 refunds and carbon rebates. Like, there's a lot of money that the government is handing out here in Canada. So it's in your best interest to file the returns in Canada and get those free cash and free money. But otherwise, the first 15,000 is not taxable in Canada. So you can decide to do nothing for the first 15,000. So in your case of 2,500, fine, no issues, leave that out. However, the fact that she's a student going to university, there are credits. So I would, still file the return. Richard, why are Canadian professional athletes working for US team considered at a disadvantage? Again, it's an involved question. We have very limited time, so I'm sorry I cannot answer in detail. But reach out to me, and hopefully I can either refer you to another site that has some details, or provide some explanation. Amy, how is depreciation treated in Canada? Well, accounting depreciation is, has no relevance. Means, from a tax perspective, accounting depreciation is nothing. The tax depreciation has to be calculated under the prescribed rules, and the prescribed tax rates are applicable: 5%, 10%. Depending on the type of the property, there are rules associated, and then you're only allowed to deduct the tax depreciation. Accounting depreciation, we don't care about that for tax purposes. Dado Kane has a question. The rate share on capital gain slide are after applying the 50% or before? Well, that is that 50% is reflective of the income. So I'm assuming that you are looking at 100% of the income at gross. So $100 taxed at the final tax on $100, so gross amount. It's before applying the 50%. Okay. Kevin, great presentation. Long-term gains, I do not think there is a okay. It's just more. Um, um, Sorry, I don't follow the question fully, but feel free to email me, and I'll try to answer it. Frank, does the Ontario provincial tax apply to Canadian non-residents? And if it does apply, would a US person be able to claim a foreign tax credit on a US tax return for Ontario taxes? Well, that's correct. I think on the US side, you should be able to claim foreign tax credit. for Canadian tax, because Ontario taxes is the, taxes paid on income. So as long as you're paying tax on income, federal, Ontario, generally Ontario tax, as I said, it's harmonized with federal, so you will be paying only single tax to the CRA. So, unless you're talking about HST. Now HST, I don't think you can get foreign tax credit for HST paid in Ontario, but for income tax that you're paying in Ontario, you should be able to claim a foreign tax credit, hopefully. Again, I'm not a US tax expert. I'm just answering the question there. Okay, the next one is Amy. In the beginning, you mentioned that you handle cross-border issues with the US. Do you understand the US income tax enough to process Canadian tax return on a Canadian citizen that have been living in the US but moving back? Yes, I should be able to answer yes. So, I do handle cross-border, and if it's a dual resident, okay, especially Canadian resident, I can take care of the Canadian tax filings. Okay, I know enough about the US to be dangerous, but I'm not an expert. In the US. I don't practice US tax, but I have decent knowledge. Jill has a question. Oh, I think that's just a comment. The exclusion of one time per lifetime in Canada, on principal residence fully exempt. Um, Glenn has a question. How are director fees paid to Canadian resident taxed in Canada? How are well, that's almost like payroll. If director fees, um, it's treated as a payroll. So taxed as your regular salary to directors. Do you have $250,000 loss deduction for active participation for landlords, Robert? No, there is no such thing as deductions for active participation for landlord. If if you're operating a rental property as a bed and breakfast, then you can call it a business and deduct more expenses. But if it's a passive income, of it's a passive income. But if you're actively managing it and it's treated like Airbnb or bread and breakfast type operation, then it's a business versus your capital treatment. Jesse, capital gain, is there a distinction between short term and long term? No, in Canada we don't have those distinction for capital gains. Shelley, is the sale of principal resident taxed in Canada? The answer is no. Principal residence where you live is fully exempt. All the gains are exempt. There's reporting required on the tax room, but fully exempt. And then I don't think if I'll be able to finish all of these questions, but I want to leave last 1 minute for Gabriel. So Donna, would I have to file a T2 tax return for my company incorporated in the US? Well, if you are incorporated in the US, just the incorporation in of itself does not trigger Canadian tax filings. But if you're doing business in Canada, or if you often travel to Canada for meetings and visits, or you're doing installation construction projects in Canada, like anything in Canada, if the company or representative contractors have to visit Canada for anything, yes, you have Canadian tax obligations. Or if the Canadian customer has already withheld taxes, then I can help you get the refund of withholding taxes. Again, that's very important. If anyone over here has their customers or themselves taxes withheld by Canadian customers for services they provided in Canada, then contact me and we can file certain filings to get the full refund of withholding taxes. If my company is hired for a Canadian project and I send US worker, do they get T4 slips? If I submit the payroll waiver, you are fully exempt, Donna. So, if you're sending US employees, let me submit the waivers and there's no action required, no payroll withholdings, just compliance, which I can help you with payroll and income tax, but no taxes owing. As long as no nexus, you're fully protected in Canada under the US Canada treaty. So no taxes. It's just, some compliance. And I can help you with that. How would a US citizen be classified if he is a student at a Canadian university? Um, if it's a full-time student, wait, it depends. If they're just doing one semester in Canada, then going back, it, it's a question of fact. Say if they're here for winter semester and that's it, and then going back, or maybe 2 semesters. Um, yeah, it's just tricky, but happy to look at that scenario. I would probably need more facts to determine the residency. Robert, How do you figure out the working from home resident, which home if they move around on the border? There are rules. The key requirement is that you should be living in that house in order to claim the principal residence exemption. If I have a rental property that I've never lived in, I have nothing. Say I'm in Ontario, I have another property in BC, and I've done nothing in that house. It's been used as rental property. Then it will be very difficult for you to claim that property as a principal residence. So you have to demonstrate that it was available, or you used it for personal purposes for short time, you know, every year kind of thing. Does Canada have S corp LLC? No, we don't have these concept of S corp LLCs. Flow through disregarded type of structures. At the corp as a corporation. So corporation is a corporation, pays its corporate taxes. Any payments to owners are dividends. If you truly want a flow through treatment, go for LP partnership, LP or general partnership or limited partnership with structures. But from a US perspective, ULC is a type of entity that can allow flow through treatment, and I'm happy to guide you more. Another question from Gus. What obligation does a US resident person have in the following situation? Oh, do I have, okay, I have only 1 minute left. Gabriel,
W-
go ahead.
Yeah, why don't we make this our last question? Since you already started, go ahead and finish the question.
Okay, what obligation does a US person have in the following situation? The US person is a consultant and performs work in Canada. The Canadian entity withholds 15% tax and pays the US person that amount. Must the US file a T1 return? Yes, Gus, I can reach out to me. I should be able to help you and get the full refund of 15%, unless you have exceeded the threshold within the tax treaty. These the withholding tax of 15% is generally fully refundable. Happy to help you, and we can go back 3 years, by the way, and get you full refund. Gabriel, all yours, please.
Thank you so much, Afan. We really appreciate having you with us today and taking the time to answer all these questions.
Thank you.
To wrap things up for our attendees, the handouts, archive of the webinar, and credit will be available in your CPA Academy account within 24 hours. And if you look in your email inbox, you will find an evaluation link for this webinar, so please let us know how we did. All questions that were asked today will be forwarded in a full report to our presenter as well. Thanks again to Afan for your great content and to
Thank you.
our members for your participation. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a
Thank you.
great day, everyone.
Thank you. Bye bye, everyone.